I hope you all are doing great. So let us complete this chapter today. So we are in the topic of valuation. This is where we had left last time, and we have to resume from this. But just because there is a gap of more than 5-6 days, let me start from the beginning. Yes, good evening, Mitali, Hemant, Mansha. Very good evening. So let me just brief you about what we are discussing so that in case somebody has forgotten or lost the link. So we are in the chapter of valuation. If you remember last time what we discussed about valuation was that basically duty is computed by three methods. First is specific method where the rate of duty given in the rate schedule is per unit. The unit may be kgs, liters, centimeters, anything. So wherever the duty rate is given per physical quantity, that is called as a specific duty. The second method of computing duty is the ad valorem method, where the rate of duty is given as a percentage. Now, whenever it is given as a percentage, it is percentage of value. This value has to be determined using some specific provisions and rules. That is what is the topic that we are dealing with, which is called as valuation. The third method is based on factors of production. Like in case of excise era, we had certain goods where the duty was computed on the basis of number of machines. So number of machines you had, the rate was fixed as per machine per month. So the duty calculation was simple. No need to find out your actual output. Simply take the number of machines multiplied by the duty per month, and you'll get the amount of duty per month, and multiplied by number of machines, you'll get the total duty payable. Now, in GST as on date, we have the we have the only mechanism, that is the ad valorem mechanism. So for ad valorem, we need to find out value, and for value, if you recall customs chapter, customs had section 14 read with the custom valuation rules. GST has section 15 read with the GST valuation rules. Now, both valuation is totally different. Why? Because one is for international transactions where the dynamics are different, where you have different international norms to be followed. You have the CTO, you have the WCO, you have the OECD. There are so many factors that comes into play when it is an international transaction. However, when we are talking about GST, we are only limited to the domestic transactions, whether it is within state, which is intrastate, or it is interstate, that is within two different states. Now, because of this, the valuation rules that we are having in GST are very different from the valuation rules that we had in case of customs. First, second reason for difference is customs only deals with goods, whereas GST deals with goods and services. And in fact, the valuation rules which we are going to study today are mainly or majorly for some specified services. Why? Because as we have been discussing right from day one, service sector is the most difficult sector to comprehend and even to compute. Why? Because services are intangible, services cannot be measured, services cannot be documented, and that is why assessing how much service is provided, computing the number of or the quantum of service provided, both these things are very difficult, and hence documenting is equally difficult. Hence, computing the value of service, and finally the GST or the tax component becomes very, very challenging. Also, because services are invisible, intangible, many times within one transaction, you have multiple services which may be interlinked. And that is where again, deciphering them and finding out the value, the tax, the exemption for each one of them at times may be difficult. That is why we have a concept of composite supplies, mixed supplies, but again, it comes with its own challenges. Now, having said all this, we come to the most important part, that is valuation. In valuation, you have section 15, which has 5 subsections. And if you remember, you have to start with subsection 5, which says that if there is any value notified by the government, your valuation will be done taking that value. So subsection 5 says that notwithstanding anything contained in the other two valuation sections, that is subsection 1 and 4, the value shall be determined as may be notified by the government. That's it. So value will be on the basis of what the government notifies, and that you have to follow. So the government will notify, and on that basis, you will have some method prescribed for computing the value. Now, once you cross subsection 5, that is where no value is provided for you, you come to subsection 1. Now, subsection 1 is the main section for valuation. Why I am saying it is the main section for valuation? Because the major valuation rules for majority of the transactions would fall here only. What it says? It says your value will be the transaction value. What is this transaction value? Transaction value is the value at which you have entered into your transaction of supply, in simple words. So it is the value at which the supply was made. That is a transaction value. However, for accepting transaction value, you have three conditions. If all the three conditions are satisfied, you take your value, and to that value you add 2 and you subtract 3. You get the final taxable value. However, if any one condition out of these three is not satisfied, you have to come to subsection 4. What it says? Where the value of supply cannot be determined under 1, because one of the three conditions is not satisfied, the value shall be determined in the manner prescribed, for which we have the rules. Now, what are the three conditions in subsection 1? Out of these three, two are expressly mentioned, one is implied. So what are the two expressly mentioned conditions? It says that supplier and recipient are not related parties. First condition. Second condition, price is the sole consideration. That is, whatever price you are quoting is full and final. There is nothing in addition to that that is flowing to you. So that is your final price. That is your final value. Now, when is buyer seller said to be related? For that, the section gives an explanation. It says that two persons shall be deemed to be related if one, they are officers, directors of one another's business. So mainly here, company and the directors are covered. Two, they are partners in the business. So here the firm and the partner is covered. Three, they are employer-employee. Four, one of them is holding at least 25% of the voting stocks or shares, which means nothing but mainly the equity shares. Next, one of them is directly, indirectly controlling the other. Now, here the control is not through shares. Why? Because that is already covered over here. Here, the control is by controlling the board of directors, influencing the decision making. That is how they mean control. Then both of them are controlled by a third person, or together they control a third person, and finally they are members of the same family. Now, what is family over here? That is also defined. Family over here means your spouse, your children. Now, for this point, there is no condition of dependency. And then in the second part, your parents, grandparents, brothers, sisters, provided they are wholly mainly dependent. So this is what is family. Now, after you have checked that you are satisfying these conditions or not, you decide, or you rather not decide, you confirm that yes, subsection 1 is applicable. Now, two express conditions you are checking: first, whether the supplier recipient are related parties; two, the price that you are stating is the full and final price, there is no additional consideration flowing. Now, third, what is the implied condition? The implied condition is that this supply is not a schedule 1 supply. In other words, it means that there is a value fixed. Why I'm saying this? Because if there is no value, it means it is a free supply, it is a schedule 1 supply, then there is no question of there being a transaction value. Because what is the transaction value? It is the price which is actually paid or payable. Now, if there is no price which is paid or payable, why? Because it is a Schedule 1 supply. Then also subsection 1 fails. You have to go to subsection 4, that is valuation rules. So these are the three conditions which, if satisfied, subsection 1 is applicable, which simply means whatever price you are stating in your agreement, in your PO, or in your invoice, that is the price which we are accepting. That is what is your transaction value. Now, this price is accepted subject to adjustment of subsection 2, where something has to be added to this price if it is not already included, and subsection 3, where something has to be subtracted. Now, what has to be added? Subsection 2, clause A. It says that you have to add all other taxes, duties, fees, cess, surcharge, levy. All other means other than GST. If they are charged and if they are collected by the supplier from you, it means in your invoice, the supplier has added that amount. It is added to the value of supply. So if there is any tax, any local tax or any customs duty, any tax other than GST, which is included, which is charged by the supplier, that has to be added, and the cumulative value will become the basis for finding out GST. This indirectly also means that GST will not be included. So if your price given is inclusive of GST, you have to do back calculation for determining what should be the taxable value. Then you come to clause C. Clause C says all other incidental expenses. Now, what are incidental expenses? Here you apply the logic of composite supply, whereby it means that whatever other costs which are normally added by the supplier, like packing charges, transportation charges, loading, unloading charges, all these are the common expenses which are charged. This is what they have called as incidental expenses. They have given some illustration. They say including commission, packing, which is charged by the supplier to the recipient. This all will have to be added. Again, when I say it has to be added, it does not mean that you have to again do addition mathematically. It means this should be part of the value. Now, if the value which is quoted by the supplier is already including this, nothing doing, the condition is satisfied. But if the supplier has given value of goods separately, transport separately, packing separately, loading, unloading separately, then for the purpose of determining GST, you'll add up all these values, and on this cumulative value, you calculate GST. Then comes clause B. Clause B is slightly different from clause C. Many times we mix between B and C. C says that there is an amount which originally the supplier was supposed to pay. So this amount was originally contracted as an expenditure, as a liability, as an obligation of the supplier. So it means if, let us say, we have agreed for doing construction, I'm the supplier, you're the recipient. We have agreed for the price of 1 CR in which I'll construct a particular structure and give it to you. And for this, my contract says I will bring a particular quality cement, I'll bring bricks, I'll bring a particular type of paint and all these things. And this is what I will be using for making this structure. However, when we are executing this contract, it is found that some of this item as per the requirement of quality is not available. In such a case, the recipient, that is you, say that since the required quality is not available, hence you are providing that much quantity of material so that your work is not hampered, you get the best quality. Now, let us say you are providing me with the cement or you are providing me with the paints. So what I say, okay, no problem. This actually I was supposed to bring in. So whatever is my contract price of 1 CR, we will reduce this price by the value of the cement or paint that you have brought in. So we make it 85 lakhs. Now in this particular case, I will be raising invoice of 85 lakhs on you. However, for the purpose of clause B, we have to add in this 85 lakhs whatever is the cement or the paint which is provided by the recipient for this contract. See, the recipient is not going to charge any amount to me, obviously, because it is used in the recipient's work only. However, originally this was my cost. Originally, this was my responsibility. Hence, it has to be added separately. This is what is clause B. Mitali, beta, I know it is already covered. I'm just revising it because when we are going to see the valuation rules will have some linkage with this. So as a normal methodology, every lecture at the start, when we are continuing the same topic, I just summarize the topic in the first 15-20 minutes and then we proceed to the next part. Fine, beta? Clause D. What does clause D says? If the supplier has supplied the goods or service to you on credit and given you some time period for making the payment, but you fail to make the payment, in other words, you are making the payment of my consideration late. Now, as per the contract, where you are making payment of my consideration late, I am supposed to levy additional amount in the form of interest or late fees or penalty, whatever name is called. In that particular case, this additional amount will also be considered as part of my supply. So my original supply was of rupees 2 lakhs. I had given you 1 month credit. You made payment to me after 3 months. So you are late by 2 months. So I ask you to pay 10,000 extra for this 2 months delay. So when you will be paying me this amount, at that time, I will raise a debit note for this 10,000 because original 2 lakhs I have already raised invoice for which I have already discharged GST. Whenever you make payment to me of this penalty of 10,000, I will raise a debit note and this particular 10,000 will be considered as part of original supply. It means the HSN, the GST rate of the original goods or service would be applicable on this interest. No separate interest, HSN or rate of tax would be applicable. So if originally I had supplied goods of 5%, this particular interest penalty would be levied at 5% only, classifying them as goods. And then clause E says that if there is any subsidy given, that subsidy will also be included in price except where the subsidy is given by central or state government. Now, what has to be excluded from the value? What has to be excluded is the discount. Now, discounts can be of two types. First, the discount which is given at the time of supply itself. That is, when you are buying at that time itself, the supply or the value is adjusted, is subtracted with the amount of discount, and you have to pay only the net amount. So in this case, such a discount is also excluded from the value. In other words, you'd never have to pay tax on the MRP or the printed price or the quoted price. You always have to pay tax on the final bill amount, which is always after adjusting the discount. The second type of discount is where the discount is given later. Now, these discounts are generally in the form of cash discounts, where you are given this discount later when you come to me for making the payment before the due date. So since you are making payment to me before the due date, hence I'm offering you some extra benefit in the form of discount. This is a cash discount. Now for this cash discount, the adjustment would be made. In other words, we will reduce it from the value. But for this, two conditions are required. One, there is a prior agreement, that is we have already decided beforehand itself that if you make payment early, I'll give you cash discount. And second, most important, this discount will be given by raising a credit note. So supplier raises a credit note. Because of this, supplier sales value of the current month is reduced. So the supplier gets benefit. At the same time, the recipient has to reverse its corresponding ITC. So this is what is the most important point relating to this particular case. So this is about the valuation rule. Now, once you are falling in subsection 4, what is subsection 4? That the condition of subsection 1 is not satisfied, because of which the transaction value cannot be accepted. In such a case, we go to valuation rules, which is given in subsection 4. Now, these valuation rules are part of the CGST rules. They are given in chapter 4 of the CGST rules. So now what we are studying is chapter 4 of the CGST rules, starting from rule 27. Up to 26 is the previous rules for the previous chapters. From 27, we start with the rules dealing with valuation. Now, one by one, we go to the rules. What does the rule says? First, 27 says, value of supply of goods or services where the consideration is not wholly in money. So what does it says? Where the consideration is given in monetary as well as non-monetary form, or where it is given only in non-monetary form. How do you find out the value? For this, they say that the first preference will be the open market value. So what will be the value? It will be the open market value. Second is, if open market value is not available, then what you will do is you will find a total of what? The consideration in money if you have received, and further amount in money as is equivalent to the consideration not in money. In simple words, you will find the money value of the consideration which is received, if such amount is known. Third, if the value is not determinable under both clauses, the value of similar goods, similar services would be taken. And last, if the value is not determinable under clause A or B or C, it will be the sum total of consideration in money and such further amount in money that is equivalent to consideration not in money. You can ignore this. It means value as determined by application of rule 30 or 31. What is 30? What is 31? That we are going to see. But remember, this is the sequence which you have to compulsorily follow. So go for the open market value. Open market value not available. Try to find out the money worth of the consideration which is received in kind. If that is also not possible, try to find out what is the value of goods which are similar to your goods, so what your competitors are offering. And if that is also not possible, you find out valuation as per rule 30-31 in that order. Means you first apply 30. If not possible, then you apply 31. Now here there are some questions. The first important question is, what is open market value? Because that you will find in all these rules. So let us go to the analysis. Okay. Now, how our module has analyzed, it has categorized these rules. What does it says? Rule 27 to 29, which is supplemented by 30-31, because in all these rules you will find the reference of 30-31. The valuation of supply involving non-monetary consideration, or where the transaction is with related parties. So this is basically covered in 27 to 29. Then 31A, B, C, and 32, they deals with valuation of specified supplies. 33 deals with valuation where you are acting as a pure agent, and 34, 35 other rules relevant for valuation. Fine. So all this is the broad overview. Let us go to the detailing. So first is rule 27, where it is applicable when your consideration is not in money form. Now, what it covers? It covers where the consideration is a barter. You give something, the opposite person gives something. The consideration is an exchange where you give your old amount, old particular, let us say, phone or television or some equipment, and you buy a new one by paying the difference. Or where there is permanent transfer or disposal of business asset. This, if you remember, is a Schedule 1 entry where no consideration is charged. Now, for all this, what is the value? The value is first take open market. If not open market, find out the money value. If not, find out value of like. And if not, go to the rule 30 and go to rule 31. What are they? Will understand. But let me take you one by one to this by going to the definitions. First is the definition of open market value. Now, what is open market value? This word will come everywhere. So we'll first understand what is open market value. Then we can go and check the rule again. Open market value means full value of money excluding the taxes. Which tax? That is a GST. So anyways, our taxable value is before GST. So we want that value payable by a person to obtain such supply at the time when supply being valued is made, provided such supply is between unrelated persons, price is the sole consideration for such supply. Now, this is what is the definition the law is giving. What it means in simple words, I'll give you a simple example. So let us take a very practical example to understand this rule. What is this example? Pay attention. I am providing you, no Mansha, but it is not fair market value. Fair market value is our third category. See, fair market value is this. This is fair market value. So open market value is not fair market value. Fair market value is this, right? Let me explain. See, let us take a simple example. I am providing you this coaching service. Now for this coaching service, I have a fees of 20,000. Now let us say Mansha comes and tells me, sir, I will do another service for you. What is the service? I will do online marketing of your classes for this whole term. So I say, okay, great. So what we decide is we decide a barter transaction whereby I am going to give Mansha this particular coaching service, and in return, as a consideration, Mansha will also be doing a service for me. That is, she will be doing my online marketing of my entire this particular class, so that she'll promote everywhere and she'll do the regular social media engagement, promotion, everything. So we agree to this. Now this transaction fits in rule 27. Why? Because here the consideration which I am getting is not in monetary form. Now in this particular case, how do we find out the value? Now, okay, I'll just make one small change in this example. Let us say I'll tell Mansha, okay, whatever service you are giving to me, that's fine, but you have to pay me 5,000. So don't pay me my total fees of 20,000, you pay me 5,000. 5,000 plus you do this particular activity for me. So we agree to this. Again, this is falling in section 27 only because 27 applies where either the whole consideration is not in money form or where part consideration is in money and part is not in money. This is where rule 27 comes into the picture. Now, pay attention. For this particular rule 27, how do we find out the value? The answer is the first preference is you go to the open market value. Now we read some definition below. At least I was not able to understand when I read it for the first time. That is why I always understand any concept by simple real life example. So I've taken the simple real life example. What is open market value? Open market value is my fees which I'm charging to others. Simple. I will not say it is fair market value. Fair market value is the fees which my competitors are charging. That is fair market value, or it is a fees which is commonly applicable in market for this type of service. But I'm not saying that. Open market value is not fair market value. Open market value is you will check कि when I am providing this service to any other student who is paying everything in money form, what is the fees that that student is paying? That is the open market value. It simply means the price of my goods and service only, which I am charging to others. See, what is the definition? I'll read. Open market value means the full value of money before GST payable by a person. So it is the value which other students are supposed to pay to me to obtain this particular supply of coaching at the time when the supply being valued is made. So it is the fees for the same batch because I am trying to value the service which I am given to Mansha. So in this particular case, I will find out whether at this same time when I'm giving this service to Mansha for which valuation is required, what is the value which I'm charging to other students in the same batch, provided such supplies between unrelated persons. So if when I'm providing service to other students, let us say out of this Hemant is my related person, so you'll not see the fees which I've charged to Hemant because that may be discounted, that may be lesser because Hemant is my related person. So we will take the fees which I'm charging to unrelated person, and also where price is the sole consideration. See, these are the basic conditions for accepting transactionally. In simple words, for Mansha's particular valuation, you will take my fees only, which I am charging to other students, where all conditions of transaction value are satisfied. It means that fees is my correct transaction value. So let us say that fees is 20,000, which I am charging to majority of the students who are not related and where the price is the sole consideration. So 20,000 becomes my value as per the first condition or the first point in the rule, that is open market value. Anybody having any questions with this?
Sir, it means, however, we calculated price consideration in rule 15, right? Same, we add
Correct,
exercise
correct,
rules
correct, correct.
there, and giving all the discounts and
Yes, yes, yes.
everything.
Correct, correct.
Okay.
So it means what Mitali said, I'll just explain. We have to go by section 15 here, but here section 15 is not applicable between me and Mansha because that is where we came out of 15.1 because of being in non-monetary form or where the value was not clearly definable. That is why we came to valuation rule. Rule 27 says you go back to section 15 only, but where in respect of other students. So where I am also providing this service to the other students who are in the same batch, where section 15 is satisfied, 15.1 is satisfied. So whatever is the value over there, after adjusting subsection 2, after adjusting subsection 3, that value which is applicable to other students will also apply to Mansha. You are right, Nitali. So open market value is my value, which I am charging to other students, on which I am paying tax for their supplies. The same value I'll take to pay tax on Mansha's supply. This is what is open market value. Correct? B point is if open market value is not known. Now, when this will happen, let us say I am providing a service which is unique. Like when you come to me for consultancy, I am giving consultancy to multiple clients, but what consultancy I am giving to Hemant may not apply to Mitali, may not apply to Jeannie, may not apply to Mansha. Why? Because everybody's issue is different. In this particular case, again, same thing happened. Mansha comes to me for a consultancy, and in return, she says, Ki, sir, let us do one thing. I will do your online marketing campaigning for 2 months. So I said, okay, fine. I'm giving you this consultancy service, and in return, you do my marketing of my business or of my activity for next 2 months. In this particular case, when you come to Rule 27, first A point is not applicable. Why? I am not providing the same goods or service to any other person because my service is something unique. Every person's consultancy is different from the other person. So rule A or clause A fails. Then what it says, come to clause B. What is clause B? Try to find out the money value. Money value of what? Pay attention. If open market value is not known, so in my case, the open market value is not known because my service to Mansha and to all others are different. So I do not know what is the open market value for Mansha because same service I'm not giving to any other person. Now, the consideration in money plus the money equivalent of the non-monetary consideration if such amount is known at the time of supply. In other words, I'll find out whatever Mansha gave to me, the service which Mansha gave to me, is there a money equivalent? Now that may be available. Why? Because Mansha is a professional social media handler. So when I contact Mansha, she has packages that okay, for every month she will charge 12,000. So if she's providing me her service for 2 months, it means I know what is the money equivalent of the service which she has provided because for a month she charges 12,000. So it means if she is giving me the service for 2 months, I know the money equivalent which is 24,000. So in that particular case, the value of my service to Mansha will be the money equivalent of whatever she has given to me. That is this 2 months online social media campaigning activity. Fine. Third rule, what it says, where above both rules fail. Now, when above both rules fail, when from either side what we are giving to each other is unique. So what I am giving to Mansha consultancy is unique. So I am not giving to any other person. So there is no open market value. Similarly, what Mansha has given to me, there is no fixed price that she is charging because why? Because again, the service which she has given to me of against my social media handling or social media promotion is what is done separately for everyone. There is no standardization. Now, in this particular case, we do not even know what is the money value of the service which Mansha gave to me. So even point B fails. Then what we do is we go to the fair market value of my services. Like if I'm doing coaching, we'll go to see what others are doing. Or if I'm doing consultancy, we'll go to see what others are doing in the same industry. And we'll try to find out whether any other person is providing the same type of goods. What is the word used? value of supply of goods or services of like kind and quality. So I will try and see if other professionals are providing the same type of consultancy, which is of like kind and quality. If I get that, then I will find out what is the fees that they are charging. That fees will be taken as my value for Mansha services. So this is what is rule number 3. So you can call this as the fair market value. So I think the definition for this is also given. Yes. So what is the definition of supply of like kind and quality? It means any other supply made under similar circumstances, which is same or closely or substantially resembles in respect of characteristics, quality, quantity, functionality, reputation to the supply being valued. So whatever supply I have made to Mansha, which is the supply which we have to value, with this supply, if you find another supply, obviously in the market, which is same, the circumstances are similar, it is same or closely or substantially same like my supply, how it is same, characteristics wise, quality wise, quantity wise, reputation wise, then whatever fees that professional is charging, you can take that as to be my value for Mansha services. Correct, students? So I repeat, A is what I am charging to other students where 15(1) conditions are satisfied. B is whatever Mansha has given to me, you try to find out the money equivalent of that. C, you try to find out the fair market value of the service which I have given, for which we have to do valuation if somebody else is providing a similar type of service. And if all this fails, you come to rule 30 and 31. What is rule 30? If you remember in my previous lecture before closing, I had read both these rules because both these rules are the residuary rules given in all the rules. So what is rule 30? Rule 30 is the costing based rule where they say find out your cost and to that cost add 10% as markup towards your profit. So you do costing, and by doing costing, whatever is the cost you find out for your goods or services, take that cost, add 10%, this becomes the value. Now, this may be possible for goods, this may be possible for standardized services. But again, for a service like mine, which is consultancy services, even doing costing is highly impossible. If this also fails, then you come to the last rule, which is called as the residuary rule, which is given in rule 31, which they also call as the best judgment rule or the best judgment method. And it simply says, best judgment rule says that you try to find out the value applying the reasonable means, which is consistent with the entire section 15. Now, how do you apply rule 30? There is nothing given in rule 30 how the valuation will be done. So basically for applying rule 30, what we do is we go back to section 15 and we try to do some jugglery. We try to do some small adjustments here and there. And after doing that adjustment, we try to find out the value. This is how 31 operates. So practically 31 has no basis. It is more of your judgment only. So you try to find out somewhere similar type of service and you take that value. That is how valuation under 31 is done. So four types of rules are given in 27. First, my value to others. Second, whatever value I am receiving, try to find out the money worth of that. Third, fair market value. And fourth, which has two rules. One is costing, cost plus 10%, or within that, residuary rule. I hope this is clear to everyone. This is rule 27. Rule 27 is applicable one, where there is no consideration, which is schedule one, but first entry of schedule one. And two, it is applicable whenever there is barter or exchange where somebody has given the same thing in return. Same thing means they have also given something in return instead of giving you money. Now we come to rule 28. Now, as you can see from the heading, rule 28 specifically deals with again schedule 1 and it deals with schedule 1 entry 2. What was schedule 1 entry 2? Schedule 1 entry 2 was where the supply is made between distinct persons or between related persons. That is what is Rule 28. Now, if the transaction has happened between related persons, we already saw 15.1 fails. If the transaction is happening between distinct persons, there is a very good possibility that since distinct person is my own branch, I am not raising any invoice, there is no value. Again, section 15.1 fails, and that is where you come to Rule 28. This rule will not cover the valuation where the supply is made through an agent. Why? Because for that we have Rule 29. So other than agent, you'll go to the related persons and distinct persons. Now, how this valuation is made? This valuation is made similar to the above. So firstly, what all things are covered? It will cover the entire Schedule 1 Entry 2 cases, that is where it is to related persons or it is within to GSTIN of the same PAN, like interstate stock transfer, intrastate stock transfer, import of service between holding subsidiary. So all this is covered. Yes, Mansha, you're right, beta. Yes. Now, what is the rule? For Rule 28, the value is, first you take the open market value, that is the price which I'm charging to others. If open market value is not available, you take the value of goods or service of like kind or quality, that is you take the FMV. And third, where both is not available, you go by costing at 10% markup, or if that is also not possible, then you find out value on the basis of some reasonable means consistent with section 50. So as you saw in Rule 27, we have 5 methods, out of which the second method of Rule 27 is missing over here. So here we have only 4 methods. My value charged to others, or the fair market value, or my costing plus 10%, or best judgment. Now, here there is an interesting point. What it says, if the goods are intended to be supplied as such by the recipient, value is 90% of the price charged for the supply of goods of like kind and quality by the recipient to his unrelated customers. However, it is not mandatory for the supplier to adopt this method of valuation. He can opt to value the goods in accordance with valuation method prescribed above, that is ABC. Now, what is this? This method says that where I am giving my supplies to my related persons or my distinct person, and that related person or distinct person is going to do trading, that is he is going to supply the goods as such. Now, what is supplying as such? He is doing trading. So what I sold to him, he is selling further. So in this particular case, when the person to whom I sold these goods is doing trading, then in that particular case, how valuation will be done? Valuation will be done by taking their value, that is the price at which they have sold further to unrelated customers, and take 90% of that value. So whatever price they charged, you find out that price. Now that will be easy. Why? Because they are your related persons, they are your distinct persons. That is why they have taken a chance of taking this value, where they are saying you take the price at which they have sold further and just do 90% of that price. In other words, you are keeping 10% margin for them. So we are assuming that they have earned 10% margin on their price. So balance 90% becomes your value. I hope this is clear. Now, the best part of this rule is this. If the recipient is eligible for full ITC, then don't follow this rule. Then whatever you want to show in your invoice, that will be accepted. This is interesting. If recipient is eligible for full ITC, the invoice value is accepted as open market value. In other words, you don't have to go to ABC, you don't have to do 90%. Whatever amount you are charging to your related person or to your distinct person, that will be accepted. In other words, we go back to 15.1, your 15.1 value will be accepted. So let us say I am providing my coaching service to Hemant, who is my related person, as I was giving example, and I charge him only 7,000. Now, in this particular case, 15.1 fails because Hemant is my related person. So we come to valuation rule 28, which is for related person transactions. But they will say that check that whatever I am charging to Hemant, whether Hemant is eligible to get full ITC. Now, when Hemant is eligible to get full ITC, when Hemant will be utilizing my goods or service in his business, and in his business, there is no blockage of ITC. Whatever ITC Hemant receives, he gets full ITC. Now, in such a case where Hemant is eligible to get full ITC, then even if I have charged him a discounted value of 7,000, that particular value will be considered as the correct value, and you don't have to do any valuation, no open market value, nothing. It will be deemed to be the open market value. In other words, that value is accepted. So, in other words, Rule 28 has one very important, you can say, exception or a clause that whatever value you are charging to your related person will be accepted if that related person is getting full ITC of your supplies. This is what is the valuation rule in case of related party transactions or in case of distinct person transactions. It is important to note that as per valuation rule 32.7, the value of taxable services provided by notified class of service provider without any consideration between distinct persons, then if ITC available, fine. This is what we discussed above. So whatever you are charging will be accepted as the value if your opposite person is eligible for full ITC. This is rule 28. So they are trying to explain where full ITC is available, what will happen. So this is what we just discussed. Whatever you are charging will be accepted as the value. Now, in this rule, that is where transaction is between related parties, there is one very interesting circular. Now, this circular is circular relating to corporate guarantees. Now, what is a corporate guarantee? Let us first understand this. Where this is applicable, that also you'll understand. Corporate guarantee is what? A company wants to take a loan from a bank. So as you can see, this corporate guarantee is given to the banks or financial institution. Now, the banks are not ready to give loan to the company. Why? Because it is saying you are a new company. We do not have your strong financial credentials. We do not have faith in your business and your capability to repay back our loan. So we will not allow you the loan. So what happens? The director of this company or the promoter of this company, who is an influential person, goes to the bank and says, see, this is my company. I am the promoter or I am the director of this particular company. So you do one thing, you give this company the loan. I stand as a guarantor. So here, the director, the promoter, maybe in some cases the partner, it stands as a guarantee to the bank. Now, many times this is very common in corporates, especially because corporates are non-living entities, as we all know, and the banks always fear to give them a big amount of loan. So they want some person to catch hold of if there is some default. That person is generally the director or promoter. So if the director promoter is ready to give his guarantee to the bank, that guarantee is called as the corporate guarantee. Now, once you have understood this, what is corporate guarantee, now we come to this particular point. Now, see, there are three persons, director, company, and the bank. Now, the bank is giving loan to the company. And for this loan, the director stands as a guarantor. So, there is some service given by the director, who is a supplier over here, to its company, which is a related party as per the definition of related persons. What is this service? This service is the service of standing as a guarantee which is also called as corporate guarantee. So here, director has given a service to its company. What is the service it is giving to its company? That it is standing as a guarantee for its company in case of a loan given by the bank. For standing as a guarantor, this particular director may or may not charge any consideration. Now, there are two possibilities. He has charged a consideration or he may not have charged a consideration. If he has not charged a consideration, what is the value? The value is 1% of the amount of guaranteed offer, and this 1% is value per annum. If he has charged a consideration for standing as a guarantor, the value will be higher of this amount. So the simple answer is, now firstly, what is a transaction? Understand what is corporate guarantee. Director stands as a guarantor for its company, for so that the bank can give loan to the company. So the bank gives loan to the company on the basis of director's guarantee. This is the transaction. Here the service is the service of director to its company. The service is called as service of corporate guarantee. And for this service, there are two possibilities. The director may not charge any remuneration to the company. Remuneration means any type of consideration, or the director is charging. If director is not charging, the value is straightforward 1% of the guarantee. If the director is charging, you have to take higher of the two amounts, 1% or the amount which the director is actually charging. Correct? Now there are different variations in this. First, where the recipient is eligible for full ITC. This we saw even in the above rules that we were studying, that where the recipient, now who is my recipient? My recipient is my company, is eligible for full ITC. Then you don't need to do this 1%, etc. Whatever value you are charging will be considered as the value of supply of the service. So then the 1% rule is not necessary. This 1% is necessary only when my company is not eligible for full ITC. Second, loan only partly availed or not availed at all. Now this is interesting. Now, what does it means? See, many times we get loans sanctioned, but many times we do not use the loan. We just uh, get it sanctioned so that if by chance I need the loan, I will use it. So either you do not use the loan or you use only partly, but you have got the loan sanctioned. Now, please understand, when you have got the loan sanctioned, but the loan is not used, there is no service as such which the director is giving, because if the company has not used any loan, the director never has any liability of repaying to the bank. Only the loan was sanctioned. Hence, what they are saying, the value of supply of corporate guarantee will be calculated based on the amount guaranteed and not based on the amount of loan actually disbursed to the recipient. Now, this is interesting. So what they are saying, in this particular case, we are not bothered about how much the company is using. We will go by the original amount, that is the amount which was originally sanctioned. So interestingly, they are saying that we will not see how much the company is actually withdrawing or using. We will go by the whole loan amount. Further, the recipient will be eligible to avail full ITC irrespective of when the loan is actually disbursed to him and irrespective of the amount of loan actually disbursed. Fine. So where the loan is partly availed or not availed at all, still you will take 1%. This is what they have clarified. Next is takeover of existing loans. Now, what is this? Already there was a loan with ICICI Bank. Now I want to switch this to SBI Bank. This is what is takeover. Now in this case, what happens? There is a guarantee with the ICICI Bank also, which will now automatically get cancelled, and a new guarantee will get opened with SBI Bank. Now the question is, if this has happened in between the year, I have to take 1% as my value. 1% is applicable for the whole year. But within this whole year, the bank has changed. Originally, at the start of the year, it was ICICI. So you calculated 1% for the whole year for the ICICI loan. Now, in between, you change the loan to SBI. That is, there was switching of the loan. Whether you have to calculate this 1% again, that is what is the question. So what it says, in case of takeover of existing loan by another bank, since there is merely assignment of an already issued corporate guarantee, GST will not be payable again. So what has happened? I stood as guarantee at the start of the year. Now this guarantee earlier was for ICICI. Okay, afterwards it has become of SBI, but my responsibility as a director remains same. My responsibility has not doubled because I am standing as a guarantor to you for 100 crores loan. That 100 crore was there at the start also, and it was there also when you switch the loan to SBI. So the 1% will be calculated only once. Yes, Hemant, you're right. So wherever this value has to be taken as what we are discussing, the promoter director has to raise an invoice because once there is a GST liability, the documents will follow. You have to raise the invoice. You have to upload this in your GSTR1 return and you have to show it in your 3B return and pay the tax. Mansha, you are right. Punjab Haryana government had stayed the corporate guarantee taxability, but that is post that particular decisions. We have this circular, so we are all going by the circular because still there is no 100% order. See, understand one thing, there is a difference between stay and there is a difference between final order. Stay is what? Stay is a temporary relief whereby for the time being the action has been stopped. It does not mean that the court has given a final verdict whether it is taxable or not. So it is just a mere stay. It is not the conclusion of proceedings. They have not given the final order, and hence we are going by this particular circular. And anyways, beta, at our exam level, we should never apply the cases which are of high court because our exam is at the central level. So we generally follow the cases only of the Supreme Court. High Court only those cases we should follow. One, where there is a final decision, which is not there here, it is only a stay. And second, where there is no contrary decision or where that particular order is not challenged in the Supreme Court. But it is good that you are updated with all these points. Next. The next is intra-group corporate guarantee. Now, what is this? Where domestic corporate issued intra-group guarantee, GST is to be paid under forward charge mechanism. Where corporate guarantee is provided by foreign overseas entity to related person located in India, GST would be paid in RCA. So where Indian is giving guarantee to foreigner, or it is standing not to foreigner, it is standing guarantee for its foreign company. The supplier is in India, forward charge is applicable. Where vice versa happens, where for Indian company, some foreigner is standing as a guarantee. In that particular case, tax would be paid under reverse charge because the foreigner is outside India, the supplier is outside India, so the tax is payable by the recipient because it becomes import of service. Export of service. Above provisions will not apply in case of export of service of providing corporate guarantee between related persons. That is where the recipient of service between related person is located outside India. In that case, above circular will not apply. Now, corporate guarantee for multiple years or for less than 1 year. Now, why this point has come? Because the value is 1%. Now, let me tell you the background. Originally, when this circular was brought, it was only saying 1%. It did not say per annum. So there was a confusion whether this 1% is for the whole life or it is every year. If it is every year, what will happen if the period is for less than a year because you have taken loan somewhere, let us say on 1st December, the loan is taken. Now from 1st December to March, you have only 4 months. So will you still take 1% or will you make the 1% proportionate? So for this, the circular, when it was revised, it gave the answer. What it says, value of supply of said service provided for a particular number of years shall be 1% of the amount of guarantee multiplied by the number of years for which the said guarantee is offered. So GST is payable at the time of issuance of such guarantee. So where this guarantee is given for more than 1 year, 1% is per annum, so it will be multiplied by number of years. Where guarantee is provided for a period less than a year, let us say 6 months, then in those cases, the valuation may be done on proportionate basis for the period. That is, in this case, the value of supply of service may be taken as half of 1%. So in my example, if we are taking loan on 1st of December, so 1st December to March, it is 4 months. So 1% divided by 12 multiplied by 4 will be your answer. Corporate guarantee by multiple related entities. So more than one person is standing as your guarantee. Then in cases where corporate guarantee is being provided by multiple related persons, co-guarantors, we first need to determine which of the two values is higher. So first see whether 1% or the actual amount charged. Which of the two values is higher? Sum of consideration paid to co-guarantors or 1%. If the total actual consideration is higher, the value of supply will be the said amount. If 1% of total guaranteed amount is higher, GST shall be payable by each co-guarantor proportionately on 1% of the amount guaranteed by them. So where there is more than one guarantor, let us say three directors together are standing as a guarantee for that one single loan of 100 crores, then 1% is on the entire 100 crores. So this 1% on 100 crores is 1 crore. Now you compare it with the actual consideration charged by the directors. If the directors what they are charging is exceeding 1 crore, that is the total of all the three directors exceeds 1 crore, no problem. Whatever they are charging is the value, and you know the value is director wise because they are charging it actually. Problem solved. However, if this 1% is higher, because collectively what they have charged is only 90 lakhs, but 1% comes to 1 CR. So you take 1 CR as the value, that is 1%, and now you proportionately divide it between the three directors in the ratio of the value they have guaranteed. So out of 100 crores, how much each one is guaranteeing? You will take that as the proportion. Valuation of corporate guarantee provided by a related person without consideration, where the corporate guarantee is provided to a bank, financial institution by a company for providing credit facilities to other company where both the companies are related, a holding company for securing credit facilities for a subsidiary company. The activity is to be treated as supply of service between related parties even when made without consideration in terms of 7(1)(c) read with Schedule 2. In such cases, the taxable value will be determined as per Rule 28(2), what we studied above. Valuation of personal guarantee by directors to banks for the company. Let us first analyze whether the activity of providing personal guarantee by director to the of a company to the bank for sanctioning of credit facility to the company without any consideration will be treated as supply. Now, since director and company are related person, the activity of providing personal guarantee is a supply as per Schedule 1, Para 2. Now, as seen above, value will be open market value. However, as per mandate provided by RBI guidelines in this regard, no consideration by way of commission, brokerage fees, or any other form can be paid to the director by the company directly or indirectly in lieu of providing personal guarantee to the bank for borrowing credit except in exceptional cases. Consequently, there is no question of such supply transaction having any OMV. Accordingly, it is clarified that OMV of the said transaction supply may be treated as zero and therefore no tax is payable on supply of service by director to the company. However, in exceptional cases where remuneration is payable to the director, the taxable value of such supply shall be the remuneration consideration payable to such guarantor by the company directly or indirectly. Now, this is an interesting point. The interesting point is relating to where the directors are giving guarantee, and you should know that there is an RBI guideline which says that directors cannot charge a consideration legally. This is what is the RBI guideline. Now, where the director cannot charge a consideration except in some exceptional cases, then obviously there is no question of open market value because they cannot charge consideration. So that is why where they are saying that in this case, the open market value of the said transaction may be treated as zero and therefore no tax is payable on such supply of service by the director. However, in exceptional circumstances where the remuneration is payable to the director, as per the exceptional circumstances, the value of such supply of service shall be the remuneration consideration paid to such director by the company directly or indirectly. So see, this is how, interestingly, as per RBI mandate, for directors, there is a different provision given. Now, we go to Rule 29. Rule 29 deals with the case where goods are supplied through agent. Again, this is a Schedule 1 scenario. Now, when goods are supplied through agents, how will the valuation be done? First answer is valuation is open market value. That is the price at which I am selling to other persons. Or it is 90% of the price charged for the supply of goods of like kind quality by the recipient to his unrelated customer. That is, when I'm giving to agent, what the agent is going to do, the agent is going to supply it further. Now, when the agent is going to supply it further, at whatever price the agent is supplying, I will take 90% of that price. And the most important point is supplier has option to choose either of the two methods. So here it is not whichever is higher, here it is not whichever is first, here it is option. So as a supplier, I may take the price at which I am selling to others, which is open market value, or I can find out from my agent at what price the agent is selling further. I can take 90% of that as my value. Again, if the value cannot be determined as per above, because both the values are not available. In that case, you go by 10% rule, that is cost plus 10%, or you go by the best judgment assessment rule. Now this is rule 30. Rule 30 is simple. You take 110% of cost of production, cost of manufacture or acquisition of goods, and in case of service, you take the cost of provision of service. Now somebody will ask me, sir, how to find out this? So for the purpose of this, you have CAS 4, like how we have accounting standards for accounting, you have cost accounting standards. So CAS 4 is the cost accounting standard which helps you determine the cost of production or manufacturing. And for cost of providing your service, you have to go to CA Inter costing subject. Over there, you had a chapter called as operating services. Operating is for service sector, operating sector costing, or the operating costing was applicable to all service sectors. So you can use the method over there to find out the cost of provision of service. Last is the residual rule. What is the residual rule? It says that the supply need to sequentially follow rule 27 to 30 before valuing goods as per this residual rule. Service provider, however, have the option of valuing service as per rule 30 or 31 after following 27 to 29. That is, for service providers, 30 is not compulsory, obviously, because costing of service is many times a challenge. So for them, they can skip 30 and directly come to 31. But for persons dealing in goods, they have to sequentially follow. First, they have to go to 30, and generally 30 is possible for goods because costing can be done of goods easily. So maybe for goods, 31 may not be required. But for services, they are given an option that if they want, they can skip rule 30 and they can directly come to 31, because again, for services, costing is difficult. Mansha is saying rule 30 for service only. No, beta. Rule 30 is for both. Rule 30 is for goods also and for service also. See, first part is 110% of cost of manufacture acquisition of goods. So it is for goods also, or it is for service also. What we are discussing is 31, which is the residual method. Residual method says that when you are doing valuation for supply of goods, over there you have to compulsorily follow 27 to 30 sequentially. That is, you have to compulsorily first follow 30. That is, you have to do costing which is possible for goods. It means in case of goods, there is a possibility that you may not need 31. Why? Because even if the valuation cannot be done as per the above rules, you will definitely get the valuation as per rule 30, because you have to simply take cost of production, make 110%, which is easy, which is possible for goods. For services, it is saying that you have an option of valuing service as per 30 or 31. So you may skip even 30, you can directly come to 31, and this is logical. Why? Because doing costing for services at times is a challenge. It may not be reasonably possible to do a proper costing of service. So for services, rule 30 may not be applied. You can directly come to 31, but for goods, you have to compulsorily first apply 30, and even when 30 fails, then only you can come to 31, where I believe that 30 will not fail, because for goods, doing costing is generally comfortable or possible. See, this is what they have given. So for goods, you have to compulsorily follow these rules, and you have to first do 30, and only if 30 fails, you'll do 31. So for goods, following the rules sequentially is compulsion. For service, after 29, you may skip 30, you may do 30 if possible, or you may skip 30 and you can directly come to 31. Fine, beta? Okay, so anybody, any doubts before I proceed? No? Just give me 1 minute. I'll just have some water. Okay, now I have a question. Mitali said no. I don't understand for what no. Himan says I have a question on definition. Okay. What is the significance of casual taxable person in GST law? Okay. See, what is casual taxable person? You would have studied this for the first time in the registration chapter at interlevel, or now we are going to study whenever we go to the registration chapter. So mainly you first study casual taxable person there in detail, and thereafter in returns and in the procedural chapter. Now let us first understand who is a casual taxable person. Casual taxable person means, let us say, I'm a person having my business place in Maharashtra. Let us say I'm a dealer in crockery items and I have my showroom in Maharashtra. So I am a regular taxable person in Maharashtra. Now I get to know that there is a very special exhibition happening in Bangalore. The exhibition is of this sector only, where people from different parts of the country are coming with their special unique crockery items and they will be displaying their items over there. So I decide to participate in this exhibition by booking a stall. So I book a stall in this exhibition. This exhibition will be for 4 days in Bangalore. I take my crockery over there and I would be selling my crockery from the Bangalore exhibition stall. Now, in this particular case, I am going to do business from Bangalore only for 4 days. Otherwise, I'm regularly doing business from Mumbai. So my location of business, my place of business regularly is Mumbai, Maharashtra. However, for 4 days, I'm coming to Bangalore. So I am working as a taxable person casually, temporarily in the state of Karnataka in the city of Bangalore for 4 days. So the GST law requires that if I'm going to do some sale, some supply from this temporary place, I should register there for that temporary period. Now, since I'm registering there only for 4 days, 7 days, 20 days, whatever is the temporary period, I should not be stuck up in the compliance which happens every month, every year, because it is clear that I'm here only for a very short period of 4 days, 7 days, 10 days, 20 days. So the GST law has a very special provision for me whereby they treat me as a casual. Casual means a temporary taxable person in Bangalore. That is what is Heman CTP, that is casual taxable person. Now, now we are proceeding to valuation of some specific businesses. Till now, the valuation rules that we were discussing was general. General means it was applicable to everyone. Whoever was not fitting in 15.1 would come to 15.4, and from 15.4 they would come to these valuation rules, that is 27, 28, 29, 30, 31. However, from 31 onwards, that is a rule that you are seeing on your screen. From this rule onwards, we have rules for specified businesses. Now, these rules are limited only to that particular business and no other business. So, what it says, 31A, value of supply in case of this business, lottery, betting, gambling, horse racing. Now, first understand what is this value of supply, or what is not, sorry, value, what is the supply? The supply is of the bet amount. Like in case of lottery, you are buying the lottery ticket of rupees 100. So the lottery vendor is selling you the lottery ticket where you are paying the consideration of 100. And this lottery ticket which the vendor is selling you is an actionable claim. Why it is an actionable claim? Because tomorrow if you win this lottery, you are able to claim this amount by filing a case against the lottery company in case they are not paying you. And most importantly, you don't have any security for this. So if you win this lottery, there is your claim is not secured by any security given by the lottery company to you except that lottery ticket. So lottery ticket is the only proof that you have that you are the owner of this particular lottery. And tomorrow, if you win that lottery, then that particular lottery amount becomes your actionable claim. For this actionable claim, you are given that lottery of rupees 100. So this is the supply which is of specified actionable claim. If you remember, we had studied this definition earlier. Specified actionable claim now covers lottery, betting, gambling, horse racing, and online money gaming. All these have now been covered in specified actionable claim. They are regarded as goods. No, beta Mansha, this is not for online gaming. You have a separate rule for online gaming, right? So, though the rule is similar only, but this is not the rule. The valuation is similar, more or less same only, but you have a separate rule. Now, here we are dealing with these four types of specified actionable claim. One is lottery, betting. Betting is when you put a bet. So there is a cricket match going on and I put a bet. Similarly, gambling. I go to a casino and I gamble over there by putting some stake money on a particular throw of dice. And horse racing. Now, for all this, what is the value? So what it says, the new rule 31 has been inserted in the CGST rules to provide for valuation of supply of lottery and actionable claim in the form of chance to win in betting, gambling, horse racing, or in a race club. The rule provides that the valuation of such supplies will be governed by specified provisions set out in the said rule and not by any other valuation rule. So as I said, the above rules were general, they were applicable to everyone, but this particular category will apply to these specified businesses, and most important, it will not be applicable to other means what these businesses will not fall in the above rule. Now that is why many times it is said that all these rules are as per section 15.5. So since these are very specified rules for these businesses, it is stated that these rules are as per 15.5. And as you saw, we revised today also that you first check 15.5. If 15.5 is applicable, we will not check any other rule. So this is what is clear from this particular point also. Now, for different supplies, what is the value? Supply of lottery by organizing state. Organizing state means the state government which conducts a lottery, either in its own territory or sells a ticket in the territory of any other states. Now, let me tell you one thing, dear students, that in many states, you will find that the lottery is run by the state government itself because they have banned lottery for private players. But in some other states, you will find both state and the private players also having their lotteries. So it is either ways. Now, what is the value? Higher of the two amounts to be deemed to be the value. 100 upon 128 of the face value of ticket, 100 upon 128 of the price as notified in the official gazette by the organizing state. Now, this is what is the value. Practically, it is always 100 upon 128 of the face value of the ticket because there is no price which is guaranteed on any ticket. See, when this higher will be applicable, when there is any price guaranteed, there is no price which is guaranteed. And obviously, if there is any price, it will never exceed 100. Otherwise, the lottery company will always be in a loss. So practically, it is always 100 upon 128. What do you mean by this calculation? It simply means that whatever is the lottery ticket value, it is presumed to be inclusive of the GST. So that is why you are making a back calculation. Now this is where the supply of lottery is by some state government. Remember this. Then supply of actionable claim in the form of chance to win in a betting, gambling, or horse racing. It is 100% of the value of bet or the amount paid into the totalizator. What is totalizator? Totalizator is a computerized device that pools the wages bet after deduction of statutory charge and statutory taxes of various persons placing the bet and also divides the total wager amount to be distributed to the winning person. So totalizator is nothing but a portal where we all are putting 10, 10, 10 rupees. Like how if you go to any online gaming portal like Teen Patti or Rummy, if four people are paying, whatever total they have put together, that is their bet that they are putting. And why it is called as totalizator? Because it is that app which is clubbing everybody's bet and making it one whole pool amount. That is why totalizator is nothing but the computer device for us what is the value of this particular actionable claim? The value is the value of bet. So if you have put 100 rupees, 100 rupees is the taxable amount. So the difference is when the lottery is run by state government, the state government do not have to pay tax on entire 100, because in their case, the calculation is done by the way of back calculation method. That is, whatever is the lottery value, you do back calculation. But if it is not run by the state government, it will always be by back calculation. Sorry, it will not be by back calculation. Whatever is the value, the entire value would be taxable. Next. Next comes the field of online gaming, which includes online money gaming. Now, when you come to online gaming, the value is same like this. It is 100% of the face value of the bet. So what it is saying, what is the value of supply? Total amount of money a player deposits with the gaming platform, any form of payment, even virtual digital assets like cryptocurrencies are also included. Now, what is this? When you are playing a game on any online gaming portal, for playing the game, if you are putting some bet, that bet amount is the value. Now, interestingly, in gaming, let us say I have put 100 rupees in the wallet. It may happen that I am not utilizing the 100 immediately because I am playing Ludo, which only requires 20 rupees. So out of 100 in my wallet, I will remove 20 and play Ludo. Let us say I lose over there. Then I go to the next game, which is Teen Patti. Out of that balance 80, which is now left in my wallet, I put 50 in Teen Patti. Here I win rupees 90. So 90 comes to my wallet. Now, what is happening? My wallet is continuously changing. I had originally put 100. Out of 100, I'm playing different games. In some games, I'm losing. In some games, I'm winning. Wherever I'm winning, that amount gets added to my wallet. My wallet may exceed 100 at a time. My wallet may come to 10, 20, 50. Most important point is the most important point in online gaming, why they made it separate is understand this. In case of this betting, gambling, racing horse club, you put a bet of 100. Either you win, either you lose. If you lose, the 100 is gone. If you win, you get the winning amount at that moment itself. However, when you come to online gaming, in online gaming, whenever you go to online gaming website or an online gaming app, you create a wallet in which you can keep a lump sum amount. Like here, I gave example of 100 rupees. Now, out of 100, you may utilize that amount small, small, small in different games. And where you win something, again it comes to your wallet. So again, your wallet grows up. Again, you may start using the wallet. So let us say you are not withdrawing anything from the wallet. You are using that money again and again and again. So out of that 100 rupees, till now you have played games worth rupees 500. How? 100. You started putting 10 rupees, 20 rupees, 5 rupees, 80 rupees in different games. Wherever you have put, in some you have lost, in some you have earned. Whatever you have earned has come back to your wallet. Now your wallet becomes 200. Again, you start using that 200 here and there, here and there. Some places you lose. In one or two games you win. Now your wallet becomes 300. So you are using that money again and again, and your wallet may be growing and it may be exceeding 100 multiple times. Most important point over here is they will charge tax not on the amount which you are putting for playing the game. Very important. Here, they will charge tax on the amount that you are depositing with the gaming company. In other words, the amount which you deposit in your wallet. So in my example, I have put 100 rupees in my wallet at the start. The moment I put 100 rupees in my wallet, 28 rupees tax is gone. So effectively, my wallet shows 72 because they removed 28 rupees of tax. My wallet becomes 72. I am playing now using this balance 72 and I am playing it in different games. And wherever I win, I get 50 rupees, 100 rupees, 60 rupees, 90 rupees, whatever. My wallet becomes of 500. No taxes payable again. Until and unless I put again some additional amount in my wallet, there will be no tax. This is where online gaming and the above betting gambling are different. In above betting gambling, there is always one time. One time means you put a bet, you win or lose, you win, you get the money, you withdraw the money. You get the money, that's it. There is no wallet business over there. But in gaming, which is today online only, you keep on adding the money in the games. But you may have kept the deposit only once. So what rule they have made, we will not charge on the games that you are playing. We will charge on the amount you are depositing in the wallet. See what they have said. The amount of money a player deposits with the gaming platform. It is not saying the amount of money which you have put as a bet in a game. So the moment I put 100 in my wallet, tax is paid on 100. Then I may use that amount multiple number of times, playing multiple number of games. That amount may be subtracted, added again and again. No problem at all. I hope this is clear. I hope this is clear. This is why they have kept online gaming separate. Now, interestingly, what you can see here, they have said even refund amounts are included in the value. Now, what is this? Now, let us say I put this 100, 28 tax gone. I played it multiple number of times, and wherever I won, the amount got added to my wallet, and now my wallet has grown to rupees 500. So I say, okay, let me withdraw 250 rupees. So out of 500, I withdraw 250. Now, please understand, there is income tax implication separately because income tax is deducting their TDS. That is different. We are not talking about that, but just remember there's also income tax implication. So I withdraw 250. Some balance is left in my wallet after adjusting the income tax and all. I use that balance amount in the wallet for playing the games. Suddenly, I feel that my wallet is decreasing and it is nearing to zero. Why? Because I'm constantly losing the games. So this 250 which I had withdrawn, I decide to put it back in my wallet. Now, interestingly, the moment I put this 250 in my wallet, again 28% tax on this 250 will be charged and deducted. Means what? The rule that they have made in this valuation for online money gaming is straightforward. It simply says online money gaming, the value is the amount deposited with the gaming company. They are least bothered with how much you are utilizing to play. They are least bothered with how much you have won. And they will not charge any tax on the amount which you have won or which you are utilizing again and again. They will take tax only when you are depositing the money in their wallet. It means, now in my example, what has happened? Whatever you won, you had withdrawn. Now, if you redeposit it, you pay tax. Had you not withdrawn, had you kept that 500 there only and utilized it for playing, no tax was leviable. But if I had withdrawn something from that 500, like in my example, I withdrew 250, and if I'm again depositing the same 250, there will be tax again. So this is something very interesting also, but strange also at the same time, because this entire valuation rule is not going by the logic of supply as such. It is simply going by the logic of deposit. So what it says for online gaming, including supply of actionable claims involved in online money gaming, the value of supply is the total amount paid or payable to or deposited with the supplier by way of money or money's worth, including virtual digital assets by or on behalf of player. No deduction for refunds. If the gaming platform returns any money to the player for any reasons whatsoever, for example, if the player didn't use it in a game or for any other reason, that refunded amount does not reduce the total value computed. As I said, you deposited 100, tax of 100 is gone. Even if you withdraw that 100 without playing, I don't care. We are taking tax on 100, right? Then comes, in short, any money or money's worth paid by a player to the platform counts towards the value, even if the part of it is later refunded. The provisions of this rule override the provisions of Chapter 4, that is the entire valuation rules. Now, Hemant has asked a very valid question. Sir, how GST will be calculated on cryptocurrency? Now, I understand I'm understanding this question like this, that Hemant wants to ask that if somebody has paid some amount in this wallet using cryptocurrency, that is, the person has deposited cryptocurrency, correct? Then how valuation would be done? The answer is simple. Even if you have deposited cryptocurrency, like let us say you have deposited 0.00004 cryptocurrency. If this much cryptocurrency you have deposited to your wallet, it will never appear as 0.004 cryptocurrency. It will get converted into money at that day's exchange rate applicable to the cryptos. Why? Because the games that you have to play are in terms of money only. So that is where I believe the moment you deposit cryptocurrency, you will see the equivalent rupee value or on the basis of that day's exchange rate, which is already specified in the policy of the gaming companies, that if you are putting cryptocurrencies or any other digital virtual currency, how it will be valued. So they value it, they convert it into money's worth using some exchange rate. So you get the money value of that, and that becomes your value. Fine, Hemant? Then comes the next valuation rule 31C. This is applicable to casinos. Now, casinos valuation is very similar to valuation of online money gaming. The only difference is in online money gaming, you sit at your home and you play on your laptop or on your consoles or on your mobile phones. And in casino, you physically go to that casino. So let us say you are going to Goa, and in Goa, you have these casinos in the form of the boats or the what you call them as the 4 or 5 stories boats. In that, you have the casinos, cruise. So you go to one of these cruise boats and you enter there. Now, for playing, what you have to do is when you enter the casino area at the start, because inside you have multiple games, multiple tables where you are having different types of games going. But at the entrance, you have this cashier where let us say you deposit 10,000 rupees and they give you chips or coins of 10,000, which may be in the denomination of 100, 200, 500,000. You can ask them whatever denomination you want. Now, when you have given them 10,000 rupees and they have given you coins of this 10,000, the amount which you have deposited for getting the chips or coins, that is the taxable value. Again here, let us say while returning, even if you return the coins of 2000 because to that extent you have not played, it will have no deduction. The tax is payable on the entire 10,000 which is deposited at the start. So what it says, value of supply is the amount paid for purchase of the token, chips, coins, tickets, etc. Money spent to participate in any game, scheme, competition, event where tokens, chips aren't needed, like direct entry fees. So there are two components. One, in some casinos, you have to pay a lump sum amount at the start. That's it. And then you can go inside and play anything. Then you don't require coins. You have to only pay at the start. Then inside you can go and play any game. Then whatever entry fee you have paid, that is taxable at 28%. Or where you have to play by putting coins everywhere. In that particular case, when you buy the coins, whatever you have paid for buying the coins, whether you use it or not makes no difference. That entire value is taxable. So you can say somewhere it is similar to online gaming. So where someone plays at casino, value of supply shall be total amount paid or payable by or on behalf of the player for buying the token, chips, coins, tickets used for gambling, no matter what they are called. So you can call them as coins, chips, whatever. Total amount paid or payable by or on behalf of the player for participating in an event, including game, scheme, competition, or any other activity in the casino where token, chips, coins aren't needed. Fine. No deduction for refunds. If the casino gives any money back to the player, for example, if the player returns the unused tokens, coins, tickets, chips, this refund does not reduce the total value. The full amount the player paid originally is still considered the value. So as I said, the starting 10,000 what you paid is a taxable value. Now you are given the coins of 10,000. Now internally you may have won 1 lakh by playing in different games, and let us say you are very lucky and you win 1 lakh. You use that 1 lakh again for playing, you win 2 lakhs. Now you are using that 2 lakhs again and now you have become 2,000. This happens the whole day. While returning, you return that 2000. Still, there is no consideration for that 1 lakh one and use, 2 lakh one and use, or this 2000 returns. At the start, the 10,000 coins that you purchase, that is only the taxable value. Again, the provision of this rule overrides the provisions of Chapter 4, that is the entire valuation rules. And for the purpose of Rule 31B and C, that is this online gaming and casino, any amount received by the player by winning any event, including game, scheme, competition, or any other activity or process which is used for playing by the said player in future event without withdrawing shall not be considered as the amount paid or deposited with the supplier. So as I said, you paid 10,000, you got 10,000 coin. You are using this 10,000 in different games and winning, and it has become 1 lakh. Now you use this 1 lakh points and play further games, no further tax. By using that, you now win 2 lakhs. Now you use this 2 lakhs for playing different games, nothing doing, no tax again. Same thing in case of online gaming. I gave example, you had put 1,000 rupees, GST was deducted and balance was used in playing different games. Whatever you won, you again utilize. There is no GST again on that. GST is once at the start on the deposit. Till the time you do not withdraw, the same deposit which is getting rotated in the form of amount which you are winning and using, no GST again. But yes, the moment you have withdrawn and redeposited, or maybe redeposited out of your own pocket, the moment you add money, that is where the tax comes, both in casino and in online. So what they say further, this implies that when a player wins money or credits from a game or activity like casino game or online game and chooses to use those winnings to play games, to play more games instead of withdrawing them, such amount is not counted as new money deposited because you have not purchased new coins, you have not added nothing in anything new in the wallet. So basically, whatever you add to the wallet, that is what is the main taxable value. What is coming to the wallet in the form of winning amount will not be counted. This is what they are saying. So if the player keep reusing their winnings within the platform, those reused winnings don't add to the total amount counted as deposited or paid by the player. In other words, it will never become your taxable. Is this clear to all students? So these are some very interesting values. As you can see, 31A, B, C, they were not there originally. They have been introduced and they have been introduced very off late. They were not there as a part of original rules. Otherwise, they would have been numbered normally 32, 33, 34. So they were not there. They are included later on. In fact, this online gaming casino, it has been included just last year from 1st of October 2023. Is this fine? Now, after this, we again have some more sectors coming up. But before that, let us take our break. And then after the break, we'll resume with the other sectors. Like as you can see, we have to see valuation for foreign currency exchange, for agents who are booking your tickets, then special valuation methods of 5 different supplies, life insurance, vouchers, second-hand goods. So these are some special valuation rules given. So we take a 15 minutes break. We start at 7:55. That is 5 minutes before 8. Fine. So yes, we are discussing the valuation rules for some more types of industries and businesses. Let us go to the details of these. Now, what are these valuation rules? First, special provisions relating to determination of value of service. What is the service? Purchase and sale of foreign currency, which is included in money changing business. Now, please understand what is this valuation rule dealing with. So let us say I'm a money changer. You have $1 lakh. You
आपकी
want
छोकरी ने
to,
ना दोपहर में भी खाना नहीं खाया.
Mitali beta, kindly mute
कौन?
yourself. Okay. So I was saying you are a money changer. I'm a money changer. You have got $1 lakh. Now you want to get it converted to Indian rupees. So you come to me. Let us say today's dollar price is rupees 90. Now, when you give me $1 lakh, I'm supposed to pay you 90 lakh rupees. However, I will not pay 90 lakhs. I will keep some amount as my commission for doing this. Now, this commission, this service charge, this service fee, whatever name you call, becomes my value. First, now how to determine this value? For this, there are different case scenarios given, but understand this, whatever I am charging from you as my service fee, this should be my money value, or this should be the value of my supply. However, what does the rule says? The rule has brought out some very interesting case scenarios. What it says: the value of service in relation to purchase or sale of foreign currency, including money changing, is determined by either of the two methods. Method one, transaction where one of the currency exchange is Indian rupees. So out of the two currencies which are getting exchanged, one side is dollars, one side is rupees, one side is euro, one side is rupees, one side is ruble, one side is rupee. So at least one of the currency is Indian rupees. Then the value of supply is difference between the buy rate or sell rate of currency and RBI reference rate for that currency at the time of exchange multiplied by the total number of units. However, if RBI reference rate for a currency is not available, then the value of supply is 1% of the gross amount of Indian rupees provided received by the person changing the money. Now, what is this? So simply at any given point of time, RBI provides you both the rates at which you can buy the foreign currency and rate at which you can sell the foreign currency. So the first thing that they are saying is you take the difference between the buying rate and the selling rate given by the RBI. So there is some, if you go to this foreign exchange also, or if you check anytime right now also, if you can Google, you will find out what is the current changing rate of RBI. And for each currency, it will give you the two rates, buy rate and the sell rate. One, the rate at which the bank will buy from you. One, the rate at which the bank will sell to you. These rates, which are given by RBI, you will take those rates, take a difference between the two. That will be the value. Like in this example, rupees 74 per USD is one of the rates, and the other rate is rupees 75 per USD. So in this particular case, you take the difference between the two rates. One is the buy rate, one is the sell rate, both given by the RBI, and the difference between them comes to rupee 1. Rupee 1 multiplied by the number of dollars that you are exchanging. In this example, you are exchanging $100. So the value will be 100. Now, there is a possibility that for a particular currency, RBI is not providing any rate because RBI is not going to exchange that currency. So let us say you have some South African country's currency which you want to exchange. Now, there is some money changer who is going to exchange and give it to you. But RBI has not provided any formal rate for that. In such a case, how do you value? Then you have to take 1% of the gross value in rupees that you have received. So let us say the person has exchanged that particular currency for a particular value. Like in this case, $100 have been exchanged for rupees 74. So what you have received is in gross 7,400 rupees in rupees. So 1% will be the value. So 7,400 into 1%, 74 is the taxable value. So if RBI rate is available, take the difference between the buy rate, sell rate. If RBI rate is not available, then the value is taken as 1% of the gross amount. Now, second case scenario is where neither of the currency exchanges rupees. So let us say you are giving me $1 lakh and in return you want from me the Chinese yuan. So against $1,000, I am sorry, $1 lakh, I am paying you, let us say 70,000 Chinese yuan. Now in this case, on both sides, Indian currency is not there. So on both sides or the both currencies which are getting exchanged, none of them is Indian. Then what you will do? The value is 1% off lower of the two amounts. What are the two amounts? The person changing the money would have received by converting at the RBI reference rate any of the two currencies into Indian rupees. So you convert $1 lakh into Indian rupees. You convert that 75,000 Chinese yuan into Indian rupees. So for both, you take the RBI's exchange rate, convert them into rupees, find out the rupee value of both of them. Whichever is lower, take 1% of that amount. That will be the taxable value. So here they have given example. You have exchanged US dollar with UK pounds. What you have got for $9,000, you have got 4,500 pounds. Convert both of them at the exchange rate given. Out of this, whichever is lower, lower is 441. Take 1% of 441. Next, the person supplying the service may also exercise the following option based on slab rates to ascertain the value of service. However, once opted, he cannot withdraw it during the remaining part of the financial year. So first method is what we studied above. Second method is depending upon the amount involved, they have given you slabs. That is up to first 1 lakh worth of money exchange, we take 1% of the gross amount of currency or 250, whichever is higher. In other words, minimum value is 250. So even if you are exchanging below 1 lakh, let us say you are exchanging only 80,000, 50,000. So 1% or 250, whichever is higher. Then for amount exceeding 1 lakh up to 10 lakhs, that is for this range. First, you take the 1%. 1% of 1 lakh is 1,000. So you are getting that 1,000 plus. Now for the excess between 1 lakh to 10 lakhs, they are giving you 0.5%. So understand this, for first 1 lakh, it is 1%. Then for the next 9 lakhs, that is from 1 lakh 1 to 10 lakhs, it is 0.5%. And then for amount above 10 lakhs, you have 0.1%. Now see, for first 1 lakh, 1% will come to 1,000. Then for the next 9 lakhs, 0.5% will be 4,500. On 9 lakhs, 0.5% is 4,500. So 1,000 plus 4,500. So up to 10 lakhs, your amount 5,500 is freezed. Then for excess above 10 lakhs, you will take 0.1%. And then compare it with rupees 60,000. Now you have to take whichever is lower. So this is the second method given, and you are given a choice to select one of these methods. But whatever method you have selected, that method has to be continued thereafter. Now, next comes the service of air travel agent. Now see, when air travel agent books your ticket, the air travel agent is providing you this service of booking the ticket for you, determining which flight will be better, giving you best combination flights. In such a case, what will be the value for his service of doing this online booking or online booking, you say, or whatever booking? That is 5% of the basic fare if it is domestic and 10% of the basic fare if it is international. So whenever you are booking the tickets, now see, because of this online and so many apps, nowadays people are not going to agents, but still in many cases people prefer agents for various reasons. Reason one, agents can see on the portal multiple flight options which you may not be able to see when you are doing it from your various apps. Second, agents have much better idea of what is the best option, at what time it will take off, which will be the best combination to go and come back depending upon your travel itinerary. So many times people prefer going through agents. So in those cases, what will be the value of supply of service by the agents? It is 5% if it is domestic travel, it is 10% if it is international travel. Now, what is basic fare? Because the value is calculated on basic fare, it is airfare on which commission is paid normally to the air travel agents by the airlines. So that is what is the basic fare. Now comes life insurance. Now, please understand, students, why life insurance requires a special valuation rule. Rather, why all these, whatever we have studied, like money changing, air travel, and this, why they require special rules? Because one common point, if you observe in all these three, whatever we have studied, is the total amount that is in front of your eyes, that is not the value of your service. Like in case of money changing, you gave me $1 lakh, I gave you 90 lakh rupees, or I have to give you 90 lakh rupees at rupees 90 per dollar. Now, in this particular case, even though we are exchanging money worth 90 lakhs, 90 lakhs is not the value of service. What is my service? My service is giving you the facility of converting your money from one currency to another. Here, my value is not 90 lakhs. My value is only a small portion of 90 lakhs, which normally I charge as my commission or service. That is where this particular 1% rule, which we saw above, or then it was given in slab 1.5.1, that is where it comes in. So understand this, why these special valuation rules are given and why are they required? Because in many cases, you will find that in all these cases, the amount that you are having in front of your eyes is not the value of your service. Your value of service is much lesser. This amount is for some other transaction. Like money changing is a different transaction. You may have exported some goods for which you have received this $1 lakh, now for which you want the rupees. So your $1 lakh is the value of export on which already the tax and refund and everything is done. But this $1 lakh which you have received for your export of goods or service, you are coming to me for getting it converted into rupees. My service is only the facility of converting it into rupees, for which my consideration will be a very nominal amount. Similarly, in the previous service, that is air travel agent, when you are going to air travel agent, and let us say the ticket which you are booking is costing 10,000, that 10,000 is the value of the airlines company for giving you the air travel. So 10,000 is already a value of another service, which is the air travel service, for which already the airlines is charging GST. However, this agent who is helping you in getting the tickets booked or giving you the best option which suits you, which suits all your requirements, getting the best possible seat available, getting the best possible airline package available by comparing multiple airlines and applying different coupon codes, this agent gives you an option, and this option is what is the option or the service that you are getting from this air travel agent. So the 10,000 amount which is appearing is not the value of service of this agent. That is the value of the service of the airline company, because they are going to take you from one place to another, for which their service value is 10,000, on which they have already charged GST applicable to airline travel. Here, my service in this 10,000 is very small. I am only helping you book this ticket. So my value of the service is to be determined as 5% or 10%. So please understand what is the logic behind these rules, why a separate set of rules is required. Similarly, when you come to this insurance, there are two insurances, as you know. One is life, one is non-life. In non-life, you have Mediclaim, you have fire insurance, you have theft insurance, all those comes in non-life. Now, interestingly, in life insurance, again, you have two types of plans. You have the endowment plan and you have the regular plan. Now, what is endowment plan? Endowment plan is that you keep on paying premium till a particular period. Let us say your policy is of 10 years. So up to 10 years, you'll keep on paying premium. At the end of 10 years, if nothing has happened to you, I will pay back the policy amount. Now, in this particular example, let us say for 10 years, every year you are paying 1 lakh as premium. Now, here, firstly, we are not talking about the service of agents. We are talking about the service of the insurance company only. So here, the service is not of insurance agent. Here, the services of the insurance company who are giving you the insurance policy. So we are valuing the insurance policy only. Now, in this point, what is understand? Please, what is important? Please pay attention to. The important point over here is that whatever the insurance company is charging to you, is it for the insurance service or is it for something else? Like when I've given you the insurance premium of 1 lakh per annum, when you are paying me this 1 lakh, is this 1 lakh I'm taking from you is for the insurance? Answer is depends on what is the nature of policy. If the policy is endowment policy, what is endowment policy? Endowment policy is where I will return you the policy amount at the end of the insurance period if nothing happens. So let us say for 10 years, nothing happens, then I will return you, let us say rupees 15 lakhs. This is what the policy says. Now, in this particular case, the 1 lakh premium that you have been paying every year is not fully for insurance. In fact, a major part of that premium is your investment because I have to return you back that amount after 10 years when nothing happens. So understand this in endowment policy, and endowment happens only in case of life. Other than life, non-life policies are all 1 year policy. If nothing happens, the amount of premium is gone. So over there, what you are paying premium is fully for insurance. But in life policy, which is endowment policy, where you will get the policy amount return at the end, whatever you are paying is not, please pay attention, whatever you are paying is not fully for the premium. It is not fully for insurance. In that particular case, the point is that how to find out the value, because whatever premium you have paid to me is majorly going for investment because I have to return you back the amount. Now, in that particular case, if that is majorly going for investment, your investment, then the value will be determined. Pay attention. The value will be determined using this valuation rule to find out of the total premium, how much is insurance, correct? So that is what we find out with the help of the valuation rule. Now, what does this sub rule 4 says? Value of insurance services vary with the nature of policy. So first, policy with dual benefits. What is the dual benefit? You are also giving the insurance, that is risk coverage, and also investment. In case, what is the value? Value is the gross premium less amount allocated for investment savings, if such allocation is intimated to the policyholder at the time of collection of premium. So this is what is called as the endowment policy, where out of 1 lakh, the policy document or the policy terms and conditions says 70% is going for your investment. Nowadays, many times they have market link policies where they tell you that I will take this 70%, I'll invest it in share market, or I'll invest it in gold, I'll invest it in something. See the TV ads that you'll find nowadays. In TV ads, you'll find that all these insurance companies have become your investment or fund managers. And now they are giving you multiple plans. Somebody is giving you flexi plans, somebody is giving you high growth plan, somebody is giving you low risk plan. So what they are doing is they are trying to give you the plan which will tell you about the investment made in a sector. So somebody says we will invest in gold, somebody will say we'll invest in real estate, somebody says we invest in equity, somebody will say we'll make mix of equity plus debts. Now, the policy amount, the premium amount breakup is given that 70% goes for your investment. Then you know that only 30% is for insurance. So you pay tax on 30%. That is what is the first point. Second is single premium annuity policy. What is single premium annuity policy? You have to pay policy only once. That is what is single premium. In this case, they say that they assume that 10% of the premium charge is your value. That's it. Because the balance is all going for investment. Then other cases. Now, what is this other cases where I do not know this breakup? How much is going for investment? They have not informed me that 70% is going for investment. But yes, definitely something is going for investment. Why? Because I'm going to return back, get my amount back. In this case, it falls in any other case where they presume that 25% of premium for the first year is towards insurance, and for the remaining years, it is 12.5% of premium. So this particular part is assumed to be the value for insurance, and the balance is assumed to be the value for investment. So the first year premium, 25% is the taxable value. For all subsequent year premium, after the first year, it will be only 12.5% of the premium. And where the policy is only risk cover, which is also called as term plan. This type of life insurance is what you have taken a 10 years insurance. Every year, how much premium they are charging? 11, 12,000, not 1 lakh. Now they are charging only 11, 12,000. And the policy says, if anything happens to you in this 10 years, I'll pay you 15 lakhs. If nothing happens, your amount is zero. Means what? Whatever 10, 11, 12,000 they are charging, that is entirely for covering the risk. It is entirely your premium for insurance. Here, the taxable value is the entire amount of premium. So no deduction from this, no percentage required, because here it is fully insurance. So see the difference. This is both these, or rather all first three are your endowment policy, where some amount will be for premium, that is for insurance, and remaining will be for investment. In this, if the breakup is known, you will take the gross premium charge, but from that you will deduct the amount which is given as breakup, where what is going to go for investment, balance is for insurance, that is taxable. If it is a single premium policy, simply take 10% of the single premium amount. If it is not a single premium policy and you do not know the breakup of investment, then assume that 25% for year one and 12.5% for all subsequent years. This is the taxable value. And where it is a pure term plan means that there is no investment involved. In that case, you simply take the entire premium as your value. I hope this is clear to all. Hemant, why LIC will not charge GST? LIC has to charge GST. Do you have any recent life insurance premium receipt? Please go and
Yes, sir.
check.
Yes, sir. Premium receipt says that there is no GST.
Can you show the photo of that premium receipt? In that case,
Okay.
beta, it would be one of those premium. If you remember our exemption chapter, there was a list of certain insurance products which were exempted.
Okay.
If your insurance policy is one of those premium products, like see that if I'm recalling the name correctly, it was some Varishtha Nagrik Bima Yojana, Atal Pension Yojana, something. All those names were there. If
Okay.
those
Okay,
are the
sir.
cases, then only it is exempt. Otherwise, GST is applicable. Just go and check. If you have the receipt in front of you, if you can click a photo and share, we can check and discuss, right?
Okay, sir. The next class I will do that, sir.
No problem. But please do it, because see, our subject is very practical, and I'm happy that you all are checking and linking the things with whatever we are studying. Good. Now, Mansha has a very good question. Sir, the GST Council meetings held up to 31st of October, will it be relevant for our exams? The answer is no. Reason is that council meeting may have happened up to 31st October. The council meeting may have taken certain decisions which you get in the form of the press release. but are the press release or the recommendations of the councils converted into notifications and circulars by 31st of October? Not necessary. In fact, we have so many council meetings of earlier period also, which I had recommended so many things, but they have never seen the light of the day. That is, they never got converted into any notification circular. So answering your question, Mansha, don't see what are the council meetings up to 31st of October. See what are the circulars notification issued up to 31st of October. So whatever circular notifications have been issued up to 31st of October, only those are relevant. Again, I will say, don't worry for that. You all would be given the, what you say, the updates, additional, this uploaded on the portal. Or if I'm not wrong, if all these chapters, what we are studying, if they are revised recently, then I can assure you our BOS has taken all the efforts and pains to ensure that all updates up to 31st October have already been incorporated. Anyways, you will also be shared that additional, what you say, that updates wala small booklet that will also be uploaded if anything is left out in the notes. So you just refer these notes. If there is any other amendment applicable to your exams, you will be given in the form of additional booklet. Fine. Yes. Now the next sub rule is dealing with those persons who are dealers of second-hand goods. Now, generally, I'll give you the most simple and practical example. This is of cars. Now, we have seen in every city, you have these various car malls where they deal in second-hand cars. Now, this rule is not limited to cars, but I'm giving you a real simple real life example where you find these car malls who take old cars from us, they refurbish it, they polish it and look it, make it look decent and in a good state, and then they sell it to the customers. So what they are dealing with is they are dealing with in second-hand goods. So they are dealer of second-hand goods. Now, in this particular case, the first question is GST applicable? Answer is yes, because they are in the business of dealing in second-hand goods. However, in respect of second-hand goods, a person dealing in such goods may be allowed to pay tax on the margin. Now, this is important. That is, instead of paying tax on the total sale value, they can simply pay tax on the difference between the value at which the goods are supplied and the price at which the goods are purchased if ITC is not available. So many times what happens, these people purchase the second-hand goods from individuals. So let us say I have been using a car for 2 years. Now I want to change and upgrade to a different model. So what I'll do is I'll sell this car to the normal person. Now, since I'm an individual, no GST I have to pay. So the purchases that they are making from me is without GST. That is, they are not having any input GST, which they can claim as ITC. So many of these car dealers or majority of their car stocks are from individuals. Now, in this particular case, on their purchase side, that is input side, no GST is there, so there is no ITC. On the sales side, when they are going to sell these cars, and many times again individuals are the persons who are buying these cars, if they levy GST on the full amount, it becomes a challenge because then the value of the car increases. So they are given this option that where no ITC is claimed by them, in that particular case, they may pay tax only on the margin and not on the entire sale value of the car, right? So the purpose of the margin scheme is to avoid double taxation as the goods having once borne the incidence of tax re-enter the supply chain. The taxable value of second-hand goods, that is used goods as such after minor processing which does not change the nature of goods, is the difference between the purchase and the selling price, provided no ITC has been taken on the purchase. However, if the selling price is less than purchase price, negative value is ignored. So it means if you are selling the car at a loss, there will be no GST. Now, value of second-hand goods where ITC is not availed, it is value is selling price minus purchase price. If selling price is less than purchase price, that is there is a loss, it will be ignored, no GST on that. CGST on second-hand goods received from unregistered dealer, unregistered supplier is exempt. It means while purchasing goods from unregistered supplier, there is no GST payable because the supplier is unregistered. When ITC is availed, That is, you are selling second-hand goods, but you want to avail ITC. In that case, valuation as per normal provisions will be applicable. You will calculate GST on the entire sale value. Person who purchase second-hand goods after payment of tax to supplier of such goods are governed by this valuation rule only when they do not avail ITC. If ITC is availed, then such supply is governed by normal provisions. Margin scheme is available only for supply of used goods by a person dealing in the buying and selling of the second-hand goods. So it is only applicable to dealers, not to other persons. Now, for motor vehicle, there is something more interesting. Old and used motor vehicle, different rates of taxes have been prescribed for old and used vehicles depending upon the size and engine capacity. So if the car is small, the GST rate is also less. If the car is big, if it is Mercedes or if it is some higher brand car, and generally on the length and the engine capacity of the car, higher rates of GST are provided. So the rates may change depending upon the size, etc. of car, but here we are talking about value. So depending upon the size and engine capacity of such motor cars, the value of supply in such case where ITC is not availed is the value that represents margin of the supplier on supply of such good determined as followed. Now, how to determine the margin? Now, this is applicable when you are not a dealer in second-hand car. So let us say I had purchased the car for my use. Now I want to sell the car and I'm not dealer in cars, but I was using the car myself and now I'm selling this car second hand. Now, how do I pay tax on car? Now, remember one thing, this above rule, which we just studied, applied to any second hand goods. But now what we are going to study applies only to motor vehicle. So motor vehicle falls in above rules also and this rule also, but the above rule is only for dealer of second hand goods. This rule is for the person who has used the motor vehicle himself and now selling the motor vehicle. What it says, the value is equal to consideration received, that is my sale price, minus the depreciated value on the supply. So where I have used the car for my own purpose, in that particular case, the value will be sale price minus the WDV in my books. And this WDV is the WDV as per Income Tax Act, what we do in PGBP. Now, whatever is the difference, positive difference is my value. If let us say the difference is negative, I don't have to pay any tax. In any other case, that is where I have not used the car, it means again I'm a dealer of car, the above rule applies, that is value is sale price minus purchase price, and again if there is negative, no taxability. Most important, where ITC is availed, if I'm availing ITC, the benefit of this difference rule is not applicable, then normal value as per applicable provisions. Purchase value of supply of goods repossessed from a defaulting buyer. Now this is applicable for banks. So where the banks had given loan for purchase of car, later on the person stopped repaying the installments. So what does the bank do? The bank seizes the goods. Now in this particular case, when the bank will resell the goods, because why they have seized those, so that they can resell it and realize their money. How do the bank pay tax on that particular goods which they had repossessed and now sold? Now, main point is they know the sale value. The question is, what is the purchase value? Because they have not purchased, they have taken it from the defaulting person. जैसे अपन हिंदी में बोलते हैं ना, उनसे जब्त किया है. They have repossessed it. In such a case, there is no purchase price which the bank has paid. So what will be the purchase cost? Because we need to pay tax on the difference. So how do we find out the purchase cost? That is what is given. Many times goods taken on loan are repossessed by the lender. Lender means the bank, in the event of default in payment of the loan installment. Now, the purchase value of such repossessed asset is, how to find out this purchase value? If the defaulting buyer is unregistered, that is not buyer, the borrower. So the person to whom I have given loan is unregistered. Then we take a notional depreciation. What is that notional depreciation? So we find out the purchase value as purchase cost, original purchase cost in the hands of such borrower, reduced by 5% for every quarter or part thereof. So roughly they are taking the depreciation rate as 20% per annum, but they are computing quarterly. So for whatever quarter or part thereof the goods were used by the borrower, to that extent we will reduce the notional depreciation. And this depreciation is calculated between the date of purchase and the date of disposal by person making such repossession, that is the bank. So the date when these goods were purchased till the date the bank is selling these goods, not the date on which they have repossessed. So it may have happened that I have repossessed the goods now, but it takes me more 6 months to sell it because I am not getting a buyer. In such cases, from the date of purchase till the date of disposal, that is the date of sale, whatever is the period, you'll compute the notional depreciation, you'll reduce it. This is where when the borrower was unregistered. If the defaulting borrower was registered, the repossessing lender, that is the bank, will discharge GST at the supply value without any reduction from the actual notional purchase value. So here the reduction of depreciation will not be allowed if the defaulting buyer or borrower was a registered person. Frankly speaking, I do not accept this, at least in case of cars. Why? I'll tell you. Because if you remember ITC chapter, which we are going to study later, ITC on motor cars is anyways not available. So even if the borrower was a registered person, and let us say he had purchased motor car for his business, anyways the ITC was not allowed to the borrower. So taking the full value of sale by the bank a bit is too harsh. They should have allowed this, but fine. That is how the rule has been designed. So I hope this particular point is understood by everyone. Now, special provisions relating to determination of value of redeemable vouchers, stamps, coupons, tokens. Now, what are these redeemable coupons, vouchers? So the redeemable coupon vouchers are where, let us say, you are given a coupon voucher against which you can get something free. So these coupon vouchers are the vouchers which help you make payment of your considerations, like the token, voucher, coupon or stamp other than postage stamp which is redeemable against supply of goods or service is equal to the money value of the goods or the services redeemable against a token, voucher, coupon or stamp. So it simply means the stamp or the coupon is of rupees 1000. It means you can buy goods or services worth rupees 1000. So the value is 1000. So what is the special provisions relating to valuation? The valuation is simple. How much value of goods or service you can buy against the coupon or voucher, that will be taken as the value. So if the coupon voucher allows you to buy goods service worth rupees 1000, 1000 is the value. Then provisions relating to determination of value of service provided by notified service providers between distinct persons. Now what is this? Value of taxable service provided by a notified class of service providers without consideration. And what is a service? It is the service by notified service providers between the distinct persons. Now, what are these? What are the notified services? Okay. So till now, no such service has been notified. So basically, this rule is made to avoid invoicing between certain distinct persons. Now, till date, they have not notified. Maybe in future, let us say they notify a bank. Now, banks have multiple branches, and within branches, they transact a lot. So one branch is doing a lot of service for the other. Similarly, the other one is doing a lot of service for the first one. In such a case, it may become cumbersome for them to raise invoice on each of them again and again. So they may put those services here. Till now, no services have been notified. But maybe in future, if any services are notified, then in those cases, doing inter-branch transfer, no GST would be applicable because the value taken would be nil. Now, we come to a very important rule. This rule is coming from service tax regime, and this rule has lot of disputes, lot of confusion, and lot of misunderstandings. Now, I'll first give you an example to explain why this rule was made. And in the same example, I'll give you a variation, that is another example, to explain you what is the difference between when this rule is applicable, when this rule is not applicable. So simple again, practical example of our own CA practice. So I am doing computation of your income tax because you have appointed me as your income tax consultant. So I have to do your computation and I have to file your income tax returns. So I say that, okay, my fees for doing this is 25,000, which you agree. So I do the computation of your various heads of income. I find out the deduction. I make the complete return and I tell you that the tax payable is coming to rupees 10,000. So pay attention. 25,000 is the value of my service. 10,000 is your tax payable. Now, I call you up today saying that, sir, tomorrow is the last date. We need to pay the tax. You say, Arey, sir, there is some problem at my end. I cannot come to you, nor I can transfer you online because I'm stuck up somewhere. My bank's accounts have been for the time being freeze, whatever. So you request me, sir, can you do one thing? Can you temporarily make the payment on my behalf? And whenever I will come to pay your fees, which I will come in a week or two, I will also pay this 10,000. I said, no problem. You are my regular client. I can do that. So what I do is I pay this 10,000 tax. Now this happens practically that many times the clients are not comfortable making payment tax themselves. They are not able to understand the online portal or they are not comfortable using online banking and all those things. So practically they give the money to the consultant and the consultant deposits the money on behalf of the client. Now, in this case, when I'm raising invoice, I want to take this 10,000 also. So what I do is I raise the invoice where I show 25,000 as my service charges, consideration for doing the return preparation, and 10,000 the tax which I have paid on your behalf. I give you the invoice. You make me payment of 35,000, which anyways you are bound to make. Now the question is, when GST is to be calculated, whether GST would be calculated on 25,000 or 35,000, the answer is GST would be calculated on 25,000. Reason, now pay attention, when I paid this 10,000, which I'm now recovering from you today, I paid it on your behalf as your agent. That is, this 10,000 is not my expense. It was originally your expense. You were obligated to pay this 10,000. You requested me on your specific instruction request. I paid this 10,000 and now I'm recovering that 10,000 and it is without adding any of my profit in that 10,000. See, my service charge of 25,000 is different. That was anyways agreed. For return preparation, I'm going to charge 25,000. But when I paid this 10,000, I am not adding any of my service charge or asking to pay you 10,500 or 11,000. I am showing you the challan. Most important, this tax payment challan is also in your name because since I have paid your tax, the challan is also in your name. So I'm showing you, see, I have paid your challan. It may be the income tax, it may be the TDS, it may be GST, whatever tax I have paid for you. The challan is bearing your name. It is bearing your uh, details. I'm just paying on your behalf. And now I'm recovering that amount from you. That is where I become or I act as your pure agent. And this is where Rule 33 says कि if I have acted as your pure agent and on your behalf I have paid some amount which I am now recovering along with my service price, the amount which I have paid on your behalf as a pure agent, it will not be included. It is not includable in the value of supply. And then further it says, if it is not incurred as pure agent, the same is includable. I'll give you that example also. Before that, Mansa is saying, is this agent similar to? Good question, beta. Is this agent the same agent which we studied in Schedule 1, Para 3, Para 4? Answer is no. Not at all. Why? See this. Value of supply of service. Right? And if you read Para 3 and 4 of Schedule 1, over there the principal agent is only for goods. So this itself shows they are different. In Para 3 and 4, what is covered? I have appointed you as an agent. I will send goods to you, and then over there you will sell it further. This is what is the agent covered in Para 3. Para 4 is you will purchase the goods and you will send it to me. You are agent, you are purchasing it for me and you are sending it to me. That is Para 4. Correct? So that is never covered. Now, please pay attention. So I gave you first example of our service where pure agent concept applies and where GST will not be applicable on the amount which I am recovering from you as a pure agent. Now I'll give you another example where I'm not acting as a pure agent. And in that example, I'll variate that example and make that example of pure agent also so that you'll understand the difference. And then we will read the theory and the conditions. Now, the second example is you have appointed me as your auditor. For this, I need to travel and come to your place along with my team. I need to do it this quarterly. So annually 4 times I am coming to your place. Now, for coming to your place, I incur travel, that is transport. I have to stay there plus food. So all this cost me rupees 50,000. My audit fees is, let us say, rupees 10 lakhs. And every time I come, it is 50,000. So for 4 times, that is every quarter I am coming. So for 4 times, it is 2 lakhs. I am giving you the invoice of 12 lakhs. Where again, in the invoice, I'm showing audit fees 10 lakhs plus the quarterly charges. And maybe I'm giving you the exact bills. I'm not inflating anything. I'm showing you the travel receipts of my air flight bookings. I'm giving the hotel vouchers. I'm also giving you my food vouchers. Everything, it is 2 lakhs. In this particular case, when I'm raising invoice of 10 lakhs plus 2 lakhs, again 2 lakhs is towards expenses which I have incurred. Here, I'm not pure agent. Here, I will be charging GST on entire 12 lakhs. Now, in this example, if I make a variation, then I will not charge GST on that 12 lakhs. That variation is, if I take these invoices in your name, that is, while booking flight, I ask the agent to raise invoice in your name. While booking hotel, I ask the hotel to book or register or raise the invoice in your name. See, in all these, I will be appearing as a passenger or the person who is staying in the hotel. But the invoice is in your name, that is a company name. In that particular case, in the same example of 10 lakhs plus 2 lakhs, again the 2 lakhs becomes pure agent. I will charge GST on 10 lakhs. So what is very important in this is where I am incurring any expense, we have to prove that this is not my expense, this is your expense. And only I am temporarily paying it and I am recovering it in my invoice. Then it is pure agent. Now, how to prove this? For this, the most important condition is one, the bills of the expenses should be in the name of the recipient. Like in my first before variation, the example which I gave, when I was booking flight, when I was booking hotel, I was doing everything in my name. My name means I was taking the invoice in my name and then I was charging the invoice to you. In this particular case, when I was first taking the invoice in my name and then charging the invoice to you, in that case, pure agent rule fails. because then it becomes as if it is my expense. Once it is my expense, even if I'm recovering it from you, it becomes part of the value of supply. But where it is your expense, where the bills are in your name, and most important, I'm not adding any margin, I'm recovering as it is. In that case, I become your pure agent for that much amount of reimbursement, and there will be no GST. So broadly speaking, a pure agent is one who, while making supply to recipient, what is my supply? My supply is the return filing. My supply is the audit. Also receives and incur expenses on some other supply. What is this some other supply? First is the tax payment. In second case, it is the traveling, transport, lodging, etc. on behalf of the recipient. Now, this on behalf of recipient is proved on the basis of bills and claims reimbursement. Most important, as actual, without adding to it the value of his own supply. That is, I'm not adding any profit for such supplies from the recipient of the main supply. So where there is some other supply, and what is the some other supply? This some other supply was the residence, the lodging, the traveling, the food. It is most important is it is on behalf of the recipient. When it is on behalf of the recipient, when the invoices are in the name of the recipient, that is where I become pure agent. So what it says, the concept of pure agent is identical to the concept of reimbursement of expenses incurred by the supplier on behalf of customer. So where it is your expense, I paid it and I'm recovering from you. It is a reimbursement. I step into the shoes of agent. That is, I did that on your behalf. So I'm acting like your agent because it is on your behalf. So when I'm recovering that amount from you, there will be no GST. That is what is the point of pure agent given in this particular rule. So most important, what is the relevance of pure agent? The expenditure or cost incurred as pure agent will be excluded from the value of supply. So I will not be charging GST on that. What is this? Subject to fulfillment of conditions. First, the expenditure and cost incurred by the supplier as pure agent of the recipient of supply of service has to be excluded from the supply. But when this is possible, only when I prove that it was not my expense, it was your expense. Like in my very first example of returns, where I'm paying the tax, it is your tax only because the challan is in your name, it is your tax. So that is what is proved that it is not my expenditure. In my second example, in the variation, if I've taken the invoices of the hotel, etc. in your name, again it becomes your expenditure. There will be no tax. Now what it says, such exclusion of expenditure incurred as pure agent is possible only and only if all the conditions required to be considered as pure agent and further conditions stipulated in the rules are satisfied by the supplier in each case. Now, what are these conditions? Expenditure or cost incurred by the supplier of service as pure agent of the recipient is excluded from the value if all the following conditions are satisfied. First, the payment arises out of a contract between R and a third party. R is the recipient, that is a company, and the third party, and supplier acts as pure agent of R when he makes the payment. R means recipient authorizes the supplier to make the payment. S shows the payment separately in the invoice issued by him. That is, I'm not merging it with my fees. I'm showing my fees separately and showing the expense separately. And the supply procured by S from third party as pure agent of R are in addition to the supplies that he provides. So my supply is different. My service is written computation or audit. Besides that, I'm taking those additional supplies. Pure agent here means a person S who enters into contractual agreement with R. So here the supplier here is the pure agent who has entered into the contract with the recipient to act as his pure agent for incurring these expenses, does not hold or intends to hold any title on the goods. This is very important. And how I do not hold title on the goods? I do not have the invoice in my name. See, when do you get title? You get title when you have the document of title. This word you would have studied earlier also in various other subjects of commerce. In that particular case, the point is, when do I get title over anything? Where I have the invoice in my name. So I should not have the invoice in my name. So I do not hold or intend to hold title on the goods or services which are procured. Do not use for his own interest. So these services I'm not availing for myself. I'm not staying there because I have gone for some vacation. I'm staying there because I have come for your work. I am not using this travel or flight for my traveling purpose. I am doing this for your purpose. So these services are not for my interest. They are for your interest. And receives only the actual amount incurred. So what I'm recovering from you is only the actual amount. I'm not charging anything additional. The supplier needs to fulfill all the above conditions in order to qualify as a pure agent. In case the conditions are not satisfied, such expenditure incurred will be included in the value of supply. Right? So students, I hope you have understood this. Mansha is asking pure agent needs to be registered. See, understand beta, Mansha, I am firstly a supplier. Pure agent is only a term which is used. Now, when I am a supplier, I am already charging for my services, which is anyways a taxable supply. So it is assumed that what I am charging to you is already taxable, for which GST is there. That is why we are discussing on the pure agent part. So by default, I am registered because I am levying GST. So that is by understanding of the scenario itself that it is proved that the pure agent who is the supplier is actually registered, because the question is whether he has to levy GST or not on the expenses which he is getting reimbursed. So don't mix or don't get confused by the word pure agent. Please understand it is the supplier and the recipient. The supplier here is called as the pure agent because he is incurring some expenses on behalf of the recipient. Correct? Now, see, this is an interesting circular. I'm skipping the above one because it is not so relevant about airport levies. Now, this is an interesting circular. GST on supply of electricity by real estate companies, malls, airports, etc. I'll give you the best example. So let us say I have constructed a mall. In the mall, there are 50 various shops, big and small size. Now, what happens? Generally, a mall which is run, you all would have seen a mall. When it has multiple shops, many times the electricity connection is common and there is one common bill which is then bifurcated between all because there are sub meters installed in everybody's shop. But what happens? I get one common bill. I check the sub meters. I get to know out of this how much is applicable to everyone. And then everyone will get the respective individual bills, which I will be collecting from them. Now, here, what I do is, as that particular mall owner, or here the words they have used is the real estate owner or RWA or real estate developer, I collect the amount of electricity charges from you and I pay to the MSCB or the electricity company. Now the question is, I am also collecting rent from you because you are my tenant for that particular shop, plus I'm collecting this electricity charges. The question is whether I have to include the electricity charges in my bill and levy tax on electricity also, or I will be treated as a pure agent for the extent of that electricity charges, and I don't have to pay GST on the electricity charges. So what it is said, it is clarified that whenever electricity is being supplied as bundled with renting of immovable property and or maintenance of premises, as the case may be, it forms part of composite supply and shall be taxed accordingly. The principal supply is renting of immovable property or maintenance of premises, as the case may be, and the supply of electricity is ancillary supply. Even if electricity is billed separately, the supplies will constitute as a composite supply, and therefore the rate of principal supply, that is the rate applicable on renting, would be applicable. However, where the electricity is supplied by the real estate owner, RWA developer as a pure agent, it will not form part of value of their supply. Further, where they charge for electricity on actual basis, that is, they charge the same amount of electricity from the leasing occupant as charged by the state electricity boards, they will be deemed to be acting as a pure agent. Now, what is this difference? The difference is where I am taking from you the charges for common electricity. Common electricity means electricity used in parking, electricity used for running lifts, etc. First part is applicable because there electricity is being consumed by me in providing you the overall services of maintenance or overall services of renting. So common electricity charges, when I'm billing to you, it becomes part of the composite supply, GST is applicable. However, where you all have your individual meters in your respective shops and I'm collecting from you exactly the amount of your meters, only it is collected by me and paid lump sum. In that case, I am acting as your pure agent and the electricity charges will not be included. So for electricity, they have given both the answers. What is the difference? In the first case, when I'm collecting from you the electricity of the common area and that is divided between all of you all in some ratio and it is collected along with my rent, along with my maintenance charges, it will always be part of the composite supply of renting. GST is applicable. However, where the electricity is applicable to your respective shop's electricity consumption, for which there is a separate submeter, only I am collecting from you whatever is there. In that particular case, I act as a pure agent because here you have your independent meters. Your independent meters are showing the electricity consumption. So in that particular case, I become the pure agent when I'm collecting that electricity charges from you and paying to the government. What will be the rate of currency other than Indian rupees for denomination of value? Now, what is this point? See, when you are entering into a transaction which is having foreign exchange, you need to find out the rupee value. How do you convert the foreign currency into rupee value? You need some exchange rate. What will be the exchange rate? If the transaction is of goods, Customs Act is applicable because it will be import-export. So if Customs Act is applicable, you go by Section 14 of Customs Act, which says you have to take the rates notified by CBIC. But for services, customs law is not applicable. In such cases, the rate of exchange that you have to take for converting your foreign currency to Indian rupees will be determined by your general accounting practices. So whatever you are following in your accounting. Now, what we follow in accounting is as per our accounting standard AS 11. So AS 11 gives us that at the time of transaction, you have to take that particular day's average exchange rate of the stock market or whatever exchange rate is available. In that particular case, we take that exchange rate. So there will be a difference for converting foreign currency transactions to Indian rupees when it is supply of goods, when it is supply of service. For supply of goods, go to CBIC rate. For supply of service, come to AS 11. And then the last point is where the value of supply is including the tax. So you are charging a lump sum amount where I'm saying, let us say my fees is 20,000 including GST. Many times coaching people charge you fees accordingly that they say this fees is inclusive of GST. So when I'm saying my fees is 20,000 including of GST, how do I find out the taxable amount? We find out the taxable amount as fees, that is 20,000 divided by 118 into 100. So this gives the taxable amount. Or fees divided by 118 into 18, this gives the tax amount. Correct? So that is the complete chapter on valuation. So students, I hope you have understood every part of this. This was a very interesting chapter according to me because there were so many practical insights about so many different types of industries. So I'm sure it was very much value adding. Yes, fine, students. Excellent. So we conclude here. Next lecture, Saturday, we start with the next topic. Fine. So till then, thank you very much. Take care, all of you all, and please keep studying. Yes. Good night, everyone. Yes, sir. Thank you very much.